You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast. First, before we begin, I would like to remind you, as I always do, of this website called wealthformula.com. It is where the podcast lives, but it is also where there are an abundance of resources available to you, including free books from my friend George Newberry and from me. You can also get my ebook. It's sort of a wealth 1.0 book called 7 Secrets of Eternal Wealth by texting 44222 and typing in wealth formula, one word. Now, the advanced stuff, of course, becomes apparent down the line. There's a course that's involved there. It's called the Roadmap to Real Wealth, and that's available at wealthformularoadmap.com. Now, of course, that's an online thing, and that leads to an online community. If you're not into the whole online thing, I would like to suggest that you join us at our next Wealth Formula meetup. I believe we still have tickets left. This is April 24th and 25th in Phoenix, Arizona. Lots of interesting guests there, including, we've got, Robert Kiyosaki, CPA, Tom Wheelwright. We've got Doug Lodmell. We have got Richard Wilson from Family Office Club. We've got Ken McElroy and Dave Steele, titans in the multifamily real estate world. And I'll even be doing a talk. Check that all out. Make sure to join us. It is a fantastic event. It's not just about the speakers. It's not just about looking at the real estate that we do on these trips, but it is a tremendous opportunity to network with one another. And I don't like the word network because it's not like you're trying to get business from each other, but I think just getting to know a live community, I think it was very refreshing for people to be in a room with high-level people who already make money, who aren't just trying to escape from their cubicles, but are trying to figure out how to get to the next level together. Really fun, good time with cocktails, etc. Check it out, wealthformulaevents.com. Again, that's wealthformulaevents with an S.com. Now, as far as today's show goes, I love this character from in the 40s and 50s, Yogi Berra. He's got all these interesting quotes, and one of them I think is fantastic, which is that it's tough to make predictions, especially about the future, right? He was a wise man. No wonder they named a cartoon character after him, right? The problem is that everything we do in finance ultimately relies on some kind of understanding or belief of how the future will all play out. And as a result, we often search for prophets who can help us make a profit, right? But of course, these prophets and sages, otherwise known as economists, don't seem to agree with each other. And some of them even have secondary agendas that might influence what exactly they're saying. You know what I mean. The guys who boast about predicting the Great Recession of 2008, but omit the fact that they also predicted the Great Recessions of 2010 through 2020, right? These are the same people who are constantly telling you that the sky is falling. By the way, I'm selling gold. And gold is a safe asset, so make sure you buy some gold from me. Listen, the economy is cyclical. That is just a fact. That means if you keep saying the same thing all the time, right? Like the sky's falling, the sky's falling, the sky's falling, eventually, or shall I say periodically, you will be right. But only drawing attention to those occasional, true events that you predict is a bit disingenuous. That's my opinion, at least. Now, like everyone else, I'm looking for the sources, right? The sources that can help me predict the future. Now, wouldn't it be great if you had a source that could have predicted 2008 several months in advance before it happened, but also predicted all of the positive things that have happened since then over the next, decade, and didn't tell you things were going to hell in a handbasket? Well, you know what? The reality is that nobody's going to be 100% right. It's not really possible to do that. But it's still really useful to pay attention to good economists. It's really worthwhile. But the problem, as we said before, is if they say different things, all these prophets and sages, who's going to help you make a profit? Who do you listen to? Well, I can tell you who I listen to, and I can tell you first on how I decide on listening to those types of people. I use the same methodology that I use when I do due diligence in real estate operators. The people that I'm going to invest with, or that our equity group, our real estate investor club is going to invest with. Now, in those situations, one of the things I always say is that you got to get to know the group, right? You got to know, like, and trust them. Well, you don't necessarily have to know, like, and trust an economist, okay? But the second step is really critical, and that is to look at their track record. Again, it's easy to get some things right. If you keep saying the same thing over and over again, and it's a cyclical market, then periodically you will be right. But if you could find a source that was, say, 95% accurate with both positive and negative predictions in the economy over the past 70 years or more, would you take the predictions seriously? Well, I would, and I do. That's exactly what ITR Economics has done, and it's the reason why they are my single most trusted source of economic information. When they talk, I listen, and the good news for you is that this week's podcast will give you an opportunity to listen as well, as we have Catherine Putney from ITR Economics coming up right after this. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is a contributor to ITR Economics, specifically to their flagship publication, ITR Trends Reports. Her name is Catherine Putney, and she specializes in the applied research of business cycle trend analysis, growth cycle analysis, and implementing cyclical analysis at the practical company level. I'm not exactly sure all of what that means, but Catherine, welcome to Wealth Formula Podcast.
Thank you, Buck. I'm very happy to be here.
Thank you again. And we did have Alan Bully on the show a couple years ago, and that was really fun. We talked about his book, and but just so we get a little bit of a background on where you're coming from. Tell us a little bit about ITR Economics and what you do over there, and some of the highlights.
Yeah, absolutely. I mean, we try to make economics as fun as possible and as interesting as possible, but here at ITR, we were founded in 1948. We're the oldest privately held, continuously operating research and consulting firm in the United States. So we deal a lot with consulting and figuring out what's best for each company to make, decisions to make in regards to the economy. So we work with everything from small companies all the way up to the Fortune 500 level. And what we want to do is provide the best economic intelligence to ensure that we're instilling a good type of kind of background and environment where the business can make those profitable decisions to maximize themselves, essentially trying to maximize those profits. So we're always trying to kind of give that information on an economic level to the point where they can make that money, they can take away that information, which I'm hoping to kind of talk about today as well.
Yeah, absolutely. One of the things that I thought was pretty impressive is the ITR has been around for a long time, and the track record in terms of predictions has been pretty darn good. Can you talk a little bit about that?
Mm-hmm. Yeah, absolutely. I would definitely use the word "darn good" as well. I think we're very, very proud of that accuracy, and I think a big reason is what separates us from some other of the forecasting firms that are in the U.S. is that we don't necessarily do straight up regression modeling. Mm-hmm. We have a touch of art to it, because when you look at forecasting in terms of regression, it's using all the historical data trends that we certainly look at. but it doesn't build in the artistic factor that economics brings to the table, right? So knowing that we have, we're in an environment where tariffs are something that is causing inflation right now. That's something that a regression model cannot build into the future. So we like to kind of bring in that artistic work, bring in the kind of the nitty-gritty specialties of what how each company operates. Are you making price hikes in your business? What are we expecting from, even, I know we'll talk a little bit about the coronavirus, things like that regression modeling cannot predict. In our system, our leading indicator trends really hit home and create some really great forecasts for us.
Yeah, and I remember, I think Alan saying something like the accuracy was somewhere like 96% or something like that. Is that?
Yeah, we're hovering around 95% right now.
Yeah. And I mean, that's obviously pretty special, especially when it comes to predicting the future. It's not an easy thing to do. One of the things that Alan and the book, I keep referring to this because I think a lot of the general theses come from this book. Is he describes this idea of this next decade being the Roaring '20s, followed by depression of the '30s, and I've heard ITR talk about this. I mean, for at least 5-6 years now, just in terms of various conferences I've been at as well. Does ITR still believe those targets? And if so, what are really the driving forces behind those respective decades, the Roaring '20s and the Depression?
Yep. That's a great comment and question to ask. I mean, every time I talk about the Depression of 2030, when I go out on the road and speak, I get a lot of groans and moans in the audience. But it's always a good thing to know it's coming, right? That's the whole point, is if we know it's there, we can prepare for it, and we can utilize the next 10 years of what we're going to call, the essential Roaring '20s to our advantage to make money, because we make money in times of recession if you're prepared for it, the buy low, sell high mentality. So as we are heading through this next decade, we will hit this 2030 depression. And some of the drivers to that, I'll mention, our demographic trends, right? So we have 10,000 baby boomers each and every day retiring from now until 2030. That's a lot of people coming out of the workforce and entering into an age where they require medical attention, essentially driving up inflationary costs when it comes to the medical industry, which is already in a high inflationary environment, on top of the fact that we are somewhat financially strained on the Social Security market.
Right.
That's something that is going to be very much constrained as we head through the next 10 years. And it's not going to be one particular driver that's going to put this depression into the decline. It's going to be somewhat the aggregation and the straw on the camel's back of a multitude of factors, such as those demographic trends that we've mentioned, the inflationary trends that we're expecting with a booming economy for the next 10 years. I mean, with Social Security, there are ways to fix it. I can get into that as well, but that is definitely going to be one of the drivers on not the Great Depression, but another depression.
Let me ask you this:
Sure.
Before is when you look at the '20s, is it what makes it roaring? Because obviously, we're sitting here right now, and there's so many predictions of, okay, we're in the longest expansion of GDP in U.S. history, and it's, we're still doing well, and, half the podcasters out there in this space are, predicting a zombie apocalypse tomorrow. What drives, what is your opinion about the 20s that make it roaring?
So it's funny you asked that, because I was going to bring up the fact that, when we look back to the Roaring '20s of the 1900s, that was labeled the Roaring '20s. There was actually 3 recessions during that time.
Yeah.
During that decade, there were 3 recessions. They called it roaring because if you look at the overall trend line from the early 20s to the late 20s, it was overall ascent. So it was actually a general rising trend, but it was not impervious to recession at all. So that is what we're expecting in the next decade, that we will be still vulnerable to these downturns. And our forecast for right now is we're kind of in the middle of it. We're heading into the next couple quarters that's going to be a mild recession, depending on which industry you're in, and then another one in 2022 and heading into 23. So when I say roaring, I mean the overall theme of the economy heading into that ascent.
Let me ask you this in terms of those, and I think this is an important point to drive home because, when we talk about a decade, a positive growth decade, one that people can do well in, I think, your point is taken well, right? I mean, it doesn't mean you don't have some natural cycles, but is it ITR's take that we're not, this huge depression, or not a huge depression, but a huge recession or major depression is not really something that you're predicting in the next few years? I mean, certainly some dips, but nothing like we saw in, say, like a 2008 or something like that.
Correct. Yeah, we're not going to be heading into that 2008 territory, which that recession was driven by the housing market and things like that. We're not expecting any type of trends going on there. We will go through our rises and declines here and there, especially in 2022. We will feel a little bit of a more severe downturn, but it's not going to be comparable to what we went through the last decade for 08, 09, 10 years ago.
One of the things that I find fascinating about this, again, is, these drivers that you've brought up that lead to the 30s and stuff. But these are some long-term predictions, right? And recently, and certainly since the book was written, there have been some substantial shifts in U.S. foreign policy, trade policy, tariffs, isolationism. How do you factor in that kind of unpredictability in the long-term predictions?
Yeah, I mean, we definitely will. If things get integrated or into the marketplace, we will integrate them into our overall outlook. We're very transparent, but at this point in time, the catalyst, the drivers that I discussed earlier with demographics, inflation, even our national debt, those are long-term fundamental trends that aren't being budged right now by the foreign policy or the trade war or the recently ratified USMCA, the new NAFTA 2.0. Those aren't really moving the needle on the fundamental drivers to this 2030 depression. So yes, we could have near-term movement here and there that changes the growth or decline, which we will work into our outlook. The tax reform when it first was put into place did have a tiny bit of an extra boost on the economy, but normalized, but it did move the needle a small amount enough for us to mention it to the audience and mention it to everyone and say, here, we're going to work this in, because you're right. We don't just stick to the same exact forecast forever and ever. But at this point in time, 2030, if we see something that pops up that could potentially change it, we'll let you know. But at this point, we still don't see any type of aggressive movement in foreign policy or anything on Wall Street to change this 2030 outlook. But if it does, we'll make sure to let you know.
So there's a couple things right now that I think, just looking at, the very short term, we're in an election year. I generally, as a business owner, hate election years because fourth quarters, it seems like everybody freezes and they don't know what to do. So that is that's coming up, and then we've got this coronavirus, and it sounds like it's really potentially freezing up China. How are these two particular issues right now? How do you see them affecting us in the short term? Are these impetus for, short-term recessionary activity or not so much?
No, I think, actually, it's funny, I was going to apologize earlier for my sniffles that I've been having, so I hope it's not the coronavirus.
No, I couldn't even hear them.
So disregard that, but as we head into this cycle, we always, even before these tariffs, even before knowing there's an election cycle, this was this was expected already, this downturn that we're heading into. It's really it could potentially move the needle somewhat, but the overall theme in terms of the tariff situation is that it will cause somewhat inflation, but it won't really move the needle on the overall trend. And when we look at the election, I mean, this happens every 4 years. So it's normal to assume that, let's say on a yearly basis, that sales pick up in the Christmas time or the holiday season. That's a normal thing to expect. Yeah. Similar to every 4 years, it's normal to expect that we will see some sort of movement depending on what's going on in the who's running, and if it's more favorably to red or favorably to blue, that it could potentially either halt spending or catalyze spending. And a big thing I personally believe in is that as we head into this election cycle with the tariffs going on right now, if Trump's going out for re-election, he might take a look and say, well, are these tariffs causing a lot more good than harm in terms of my ability to get reelected, or vice versa? Are they causing more bad than good? And that could potentially move his strategy with the tariffs. He could be more aggressive with them, or he could be more reserved with them to potentially get the votes. Or
payroll taxes, right? I mean, some of these things that there's still potential role for, some tax mitigation, things that might get people excited about that. And then what about, so you guys are factoring that in already, and it seems like we've got this a little bit of decline that, as you mentioned, by the way, that we're already in. You said that, right? We're kind of already in that. Do you think that right now we are potentially already in some recession in some sectors?
It depends what sector you're looking at. When the macroeconomy, when I say decline, I could potentially be saying a slowdown, a business cycle decline, or recession. So the U.S. industrial sector right now, so if you're tied to, let's say, manufacturing or anything commodity related, that is on the brink of entering into recession. The consumer economy, when I say consumer, I mean GDP, because it's mostly personal consumption. That is actually avoiding recession during this cycle, but it is in a slowdown. So we are on the brink of 1 quarter of decline in GDP, but it will be back to the races again as we head into the second half of this year. So when I say general descent or decline, it could either be meaning slowdown or recession, depending on your industry.
Got it. So that makes sense. So basically, we're talking about, and to your point, what most people think about when they think about recessions is this, what you're describing right now is having a little bit of a slowdown and then probably picking up in the next quarter, and then maybe we don't see another slowdown or that kind of thing until 2022.
Correct. Yeah, 2021 will be a great year. 2021 will be a good year for the economy. The slowest point in anyone's business, whoever's listening, will be right here, right now, in the first half of this year until 2022. So next year will be good, but I will caveat that with the fact that that's if you move with the economy. You could lead it, you could lag it. You could be in different points in your business. Do you typically move ahead of the game? Do you move behind the game? That's important to know too, because you have to make that mental shift. Whatever you hear on the Wall Street Journal today about the economy may not pertain to your exact business at this point in time. You have to figure out your relationship to the economy.
Let's just go back to that coronavirus. What are your thoughts on this? What I mean, is it going to affect anything in the big picture or not so much?
I think on an overall business standpoint, depends what you're in. We have been seeing it, wreak a lot of havoc on people getting scared and holding back on going out, especially in China. But I think China is starting to try to mitigate that impact they're cutting down on some of their tariffs toward us they're slicing them in half to try to hopefully mitigate and increase some of the activity going back and forth, because they are seeing a lot of pullback in spending patterns, right? No one's going to go out and go to a restaurant or a shop or a park because they don't want to go out and contract the virus. But at the end of the day, the death rates between the flu and coronavirus are somewhat similar. Yeah. So I think it's more of a speculation on it rather than what the actual impact is. It definitely is impacting China more than us, and we're not going to be sending we're not going to be importing anything from China as much as we used to, given this virus, especially in the agriculture industry.
Yeah, and I actually agree with that too. My background is I don't practice anymore, but I am a physician, and I am looking at a lot of this from the standpoint of the actual health implications are really not any more than the flu, and so there's certainly a big it's a sexy thing to bring up in the media right now, but it's. Get a vaccination, you're probably from the flu. You're probably in better shape. Let's go back to the 2030s, because this is a thing that whenever you guys talk about, and I know because I've been in the audience and I'm part of the newsletter, and whenever we talk about this, people's ears perk up. And so let's talk about what it looks like. Okay, 2030s are here. ITR's predictions come true. Is this some kind of a inflationary or deflationary, or what does it look like?
Yeah, it will most definitely be inflationary as we head into the next year. Not in 2030 when everything hits the fan, but for the next 10 years, it definitely will be inflationary because of the increasing demand in the, I don't want to say the roaring 20s, but with higher demand comes higher prices.
Right.
That's at the law of economics. So that's what we'll be seeing as we head through the next 10 years, on top of the fact that the medical attention that's going to be demanded from a huge baby boomer demographic cohort, that's going to also increase a lot of the inflation as well. So we definitely think that there's going to be a lot of inflation as we head into 2030, and then I like to call it the next decade will be the stairway to heaven, and then the highway to hell will be 2030. So we'll see that decline.
In that highway to hell, though, is that a deflationary environment? Not the when you're in the 2030s, if you're holding assets, do we expect those assets to deflate in value, or do we? Basically, I'm looking at is like an inflationary depression or a deflationary depression?
I would say more on the deflationary side, because people will not be spending. So when you're not spending, prices go down. That causes the deflationary environment to take hold. Interest rates will likely be extremely low because the government wants us to catalyze spending or create incentives to go out and spend. So I would say that it was more on the deflationary side of things as we get into 2030, and then the 2020s will be more inflationary. So it's all about, a big thing is to look at the U.S. in general is a very reactionary economy and a reactionary nation. We wait for things to happen and then we fix them. We are not proactive.
Sure.
Because if we were proactive, this would not be a problem right now. And it's a very good reference here. I'm not sure if you've heard seen the movie Armageddon with Bruce Willis, and there's an asteroid coming to Earth, and basically they send out your crew out there, and you have to blow up this asteroid before it crosses a threshold. And if it passes that threshold, you're done. The Earth is done for. Similar to the economy in this 2030 depression, if we don't fix things in the next few years, we can do whatever we want in the few years before the Great Depression. It's not going to solve it.
And what would those things be?
We have to. So what we're looking at is the deviation and the delta between the tax receipts and our entitlement programs. So we have Social Security, Medicare, Medicaid, because our national debt right now is over $22 trillion. We need to move the needle somewhat by either raising taxes or decreasing those type of transfer payments by the government. Because if that continues, our debt's going to increase and increase and increase. And there's easy ways to do that, especially with Social Security. Right now, it's a 12.4% tax employer-employee contribution for Social Security. You increase that to 15%. That's decades added to the Social Security ability to pay out. You get rid of the $134,000 salary cap that's on Social Security. You add decades more on top of that, but it's political suicide.
Right. So it's not going to happen.
Yeah.
So it's not going to happen.
So if it does, that's something we'll let you know and integrate into our outlook, but we really don't think that it's likely going to take place.
The reason I keep asking you about this depression, this deflationary versus inflationary aspect is that, you mentioned a couple things about what happens in 2030s, and, all of a sudden, the Fed's going to be, you'll be, the rates will be negative. You'll have like QE 2000. And when all of that happens and there's helicopter money and reviving the economy at that point, I'm just wondering what happens if I'm owning real estate at that point. Does that real estate go way up in nominal value, or does it go down? You see what I mean? Like and I'm not an economist, so I don't really understand this part. But it seems to me that with all the activity that would be necessary to mitigate some of the pain in the 30s, that you would need to print a lot of money, right? Mm-hmm. And then in that scenario, would the value of assets nominally go up?
I think that that would be essentially mitigated by the fact that we're going to be in this depression. But assets such as real estate is something that we think you need to hold on to for this point in time. And the reason for that is because you need to weather the storm with your assets, especially on the real estate side. Own that land, because we're coming out of it in the later parts of the 2030s. So on a time frame basis, you want to hang on to that for a sole reason too. We look back at the 08-09 recession that we went through. There was a huge shift away from single-family housing into renting, multifamily, because no one could qualify for a mortgage. People were defaulting on their mortgages, so they needed to rent instead.
Sure.
So if you own housing in the next 10 years, that's a source of income for you. God forbid that a job is lost during that time in the 2030s. If that's the case, you still have assets such as housing for potentially to rent, or if your kids are out of a job, you can have a place for them to live. Things like that, where you have these assets that you're able to kind of bring in that cash flow, and then weather the storm through the 2030s and be back on your feet pretty well again. It's really difficult for housing prices to really fall off a cliff, because 08-09 was centrally housing. It was all tied to housing. This downturn in 2030 will not be all tied to housing, so we don't expect a similar type of movement in the housing market than we did 10 years ago.
Yeah, although presumably rent will have to go down. Those kinds of things. I'm also assuming that, and I'm focusing on real estate because we're such a real estate heavy show, but I would also assume that if you were going to hold that real estate through the 2030s, that you would be thinking you'd be best off probably having things with pretty low leverage.
Mm-hmm. Absolutely. Well, I think just weathering that storm in the early 2030 period, and it depends on it's different for every type of situation. You want the property by the water. Canada is a big one too. If you can get to the Great Lakes on up, the north or south side of them, those are the types of areas where you'll really come out on top, because people will probably be looking to move in the 2030s. As if the economy is wreaking havoc with this depression, people typically like to get up and move if they're out of a job, and that's when there's going to be more activity in the overall housing market.
How about throughout the world? Will this be a global depression, or is there any countries that will be spared or at least minimally hit?
Yeah, this will definitely be a global recession or depression. It will definitely wreak havoc globally. If you look at the U.S., Europe, China, and Japan, those four countries together are 76% of the global economy. I mean, that's a really, really big number there. All those four are going to be going into this depression. There are definitely going to be some safe havens, which I'll get into, but when we look at Japan, they're in. This is something I like to say is that once Japan turns, we know that the U.S. is going to follow suit, because Japan is in such a terrible population growth pattern.
Yeah.
With the one-child policy in China, even all of Asia or most of Asia is just really, really bad. The sale of adult diapers has surpassed the sale of baby diapers in Japan.
Is that
it's,
right?
It's wild. So once they're going to be the first to tip, because you think you want, in terms of population growth and birth rates, you want an upside down pyramid. You want it funnel. You want each generation to be larger than the other. I mean, my mother is one of 9.
Mm-hmm.
You don't see that anymore. So
Right.
who's going to be who's going to be stimulating this economic growth with their taxes? We need to create some more ways to increase those taxes. And I mean, Japan also, their government is tax funded, is sponsoring dating websites. Like Tinder, or those types of random dating websites, because they want people to have babies. They need to have their babies. So this will definitely be a global downturn in some of the areas that are opportunistic. And I know that Brian and Alan Bolio, our CEO and president here at ITR, they talk about it in their book, Prosperity in the Age of Decline. Switzerland, Canada, Australia, those 3 are some pretty good financially stable countries that may weather the storm a lot better. If we look at the difference between I mentioned earlier that our transfer payments in the U.S. are much higher than what we're bringing in tax receipts. It's the opposite for Canada. They're taking in more than what they pay out in terms of transfer payments. They're financially much more stable. So is Australia and Switzerland. They're going to be the winners, or they'll win the most. I'm not going to say they're not going to fall, but they're going to be the safe havens to, once Japan tips, get out of equities, go into bonds in those particular 3 countries. That those will be the safe havens, as well as the countries that have a good younger population, because those again won't be as hit as hard with the younger generation being able to kind of get back on their feet again, even absorb a lot of the assets when these older generations die off. That's something that we think that could potentially buoy the impact of this depression, is all the assets that are transferred, excluding the death tax to the younger generation, could potentially mitigate some of the severity of the downturn with all of those assets being transferred.
Interesting. Well, it is always fascinating to hear about this demographic cliff, really. From you, but so for real estate investors, hold on to things, maybe decrease your leverage, etc. during that period of time. But in the meantime, make hay, try to make as much money as you can in the next decade. I think that's the bottom line, right? So tell us a little bit more about where we can learn about your work and the work of ITR Economics. I'm a subscriber to one of your newsletters, but maybe you can tell us a little bit about that and how people could potentially sign up.
Yeah, absolutely. So we offer some great quality products and emails and services. So you can subscribe to our free services if you go to our website, itreconomics.com. There should be a resources tab at the top, and then you scroll down to the free enrollment for the updates. And what we'll do is we'll just send out periodic emails it's usually on a monthly basis, of what's going on in the economy, just kind of a blurb here and there. It's a really great piece of just insightful information for what's happening and what's new in the economy today or tomorrow.
Absolutely. And, one of the things I think is really interesting is being able to get ahead of stuff with a smart team that really is more unbiased than I think a lot of the economists that you hear in the press. So, again, thanks very much for being on the show, Catherine.
Of course, thank you. I'm very, very happy to be here and happy to do it again as well.
Thank you. That'd be great. We'll be right back. Welcome back to the show, everyone. So how seriously do I take these forecasts, these ITR forecasts that Catherine has alluded to? By the way, I am a subscriber. I can't remember. I think it's called ITR Insider. There's one that's really mostly focused on for individuals. It's not for businesses per se, but definitely check it out. So I take these things very, very seriously. And what I really appreciate about ITR is their lack of secondary motive, as I described before. They're not out there talking about the zombie apocalypse while selling gold and survival gear. And the other thing is that they routinely get it right. And it's not always, It's not always the zombie apocalypse right. It's also a bull market for the next 10 years right. They've done it repeatedly, 95% of the time for the last 70 years. That's pretty darn good. And with regard to 2008, yes, they got that one right. Several months before 2008, gave people an opportunity to make some big moves. Now, of course, in 2008, I didn't have any money anyway because I had just finished surgical training. But, who knows? I didn't know about them. But I'm glad I know about them now. So what am I going to do based on this information? Well, I've talked about it before, but I really do see this decade personally as full of opportunities. So I'm going to treat it like the roaring 20s, right? Yeah, sure, there'll be some recessions. I think I fully believe that. I think we may very well be in one right now, right? But the truth is that I'll probably sell a lot of assets or at the very least deleverage as we get near the end of this decade. Or at least, I have 10 years to try to figure out what to do before then. And obviously, we hopefully will continue having an investor club and we will do the right thing together. Now, it's tough, I know. What do you do with all these people talking about zombie apocalypses? All I can tell you is, listen, you have to make a choice for yourself. The problem with sitting on cash right now is that prediction could be very wrong, and it has been very wrong. For people who've listened to the Perma Bears for the past 5 years, I mean, listen, you've lost out on a lot of opportunity to make money. In the meantime, the rest of us have made money hand over fist. We talk about one of the Western Wealth Capital investors who's been investing for the last 5 years in every deal and turned $750,000 by small increment investing in several deals into $4 million of principal. I mean, if you got scared away by a Perma Bear 5 years ago, think of how much money that guy would have lost if he'd done the same. Listen, I'm not going to tell you what to do, but listen, if you are going to make some decisions, get educated, and the biggest thing in that regard is to make sure your information is not coming from a biased source that's trying to sell you something or is trying to, write books about survivalism or etc. Make sure that they have a good track record, good and bad. Anyway, that is it for me this week on Wealth Formula Podcast. I hope you make it out to our event in Phoenix, Arizona. Again, check that out at wealthformulaevents.com. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.